Today we will be discussing one of the common ways to save for retirement. It is known as an IRA. But before we begin, we will start with a little dose of light humor.
I'm getting married and I wanted a good, stable job, so I'm going back to accounting. So just call me Bond, Municipal Bond. Yeah, that joke killed at the accounting firm.
The individual retirement account is the most common of individually managed retirement plans. It is a savings and investment account that encompasses tax advantages. Taxpayers who meet certain eligibility requirements can contribute to IRAs. As a side note, there are other types of individually managed plans that are available to self-employed taxpayers. IRA guidelines and requirements can be found in Section 408 of the Internal Revenue Code.
When you set up an individual retirement account, there are two types of IRAs to choose from. There's the Traditional IRA and the Roth IRA. Both help you save for retirement while earning income and interest, but there are a few differences between the two. The main difference is when you pay taxes on it. In a traditional IRA, your earnings are tax deferred until you withdraw from the account, while on the other hand, in a Roth IRA, your earnings are tax-free since the distributions are not taxed. Also, you are able to deduct your contributions to a traditional IRA, but you cannot with a Roth IRA.
A traditional individual retirement account, or more simply put, a traditional IRA, is a way individuals are able to save for retirement through managing their own account. These retirement accounts also give individuals tax advantages. By definition, a traditional IRA is an individually managed retirement account with deductible contributions and taxable distributions.
The maximum contribution amounts for a taxpayer in 2014 depends on the taxpayer's age. The maximum contribution for someone who is at least 50 years old is $6,500. If you are under age 50, the maximum contribution is $5,500. After a taxpayer reaches 70 and a half, they are not allowed to make regular contributions to their IRA at all anymore. Taxpayers may contribute into their IRA up to the unextended tax return due date. For example, contributions made during any part of 2014 and the beginning of 2015 up until April 15th of 2015 will all be credited towards the 2014 tax year.
Contributions to traditional IRAs are for AGI deductions, which are shown on the first page of the Form 1040. There are limits to how much of your contribution you can actually deduct. For those taxpayers who are less than 50 years of age at the end of the year, may deduct up to $5,500. For taxpayers who are at least 50 years of age or older at the end of the year, may deduct up to $6,500. And finally, for those taxpayers who are 70 and a half years old or older at the end of the year, cannot deduct any part of their contributions. But this usually does not have a negative impact, as most taxpayers are already withdrawing funds from their account by this age. This is one of the benefits of having your savings in a traditional IRA. Some of the factors that can affect the limitations on a taxpayer's deductions are: 1. If the taxpayer is already participating in a retirement plan that is supplied by their employer. 2. Their filing status. 3. The amount of their earned income. And 4. The taxpayer's AGI. If you are currently in a retirement plan that is provided by your employer, your eligible deduction is phased out. For single taxpayers, the deduction is phased out between an AGI of $60,000 and $70,000. For married filed jointly taxpayers, their deduction is phased out between an AGI of $96,000 and $116,000.
Unmarried taxpayers have their own benefits and limitations. Those who do not participate in employed retirement plans are allowed to deduct IRA offerings up to the lesser value of $5,500. It's $6,500 if the taxpayer is over 50 years of age or the taxpayer's earned income for that tax year. Earned income will commonly comprise of salaries, compensation, alimony, wages, and tips. The individual's net earning from self-employment is also included because it is still considered income earned by the individual's labors. Unmarried taxpayers that do decide to participate in employed retirement plans are allowed to deduct IRA offerings of the same amount as those taxpayers who do not participate in employed retirement plans. The only difference is that the maximum deduction is phased out. This phase-out depends on the unmarried taxpayer's adjusted gross income, or AGI. The phase-out reads, if AGI is equal to or less than $60,000, there is no phase-out. If AGI is between $60,000 and $70,000, then there will be a proportional phase-out of the full limit. The phase-out percentage can be calculated by a simple equation. Taxpayers' AGI minus $60,000 divided by $70,000 minus $60,000. If AGI is equal to or less than $70,000, there is a full phase-out with no deductions.
Each spouse can make deductible contributions to their own IRA. Their phase-out is the maximum deduction amount for the spouse with the higher income. Spousal IRA is the contribution to the lesser earning spouse's IRA. The money in the account belongs to the lesser earning spouse no matter where the funds for the contribution came from. Married taxpayers who file separately can also make deductible contributions to an IRA. The maximum deduction for the spouse with the lesser amount of earned income is the lesser of $5,500, $6,500 if the spouse is over 50, or their total earned income of both spouses minus deductible and non-deductible contributions to their other spouse's traditional IRA and by contributions to the other spouse's Roth IRA. There are three different situations that can present themselves. If a spouse participates in an employer's retirement plan and they file jointly, the maximum deduction for that spouse is phased out based on the couple's AGI. There is no phase out if the couple's AGI is equal to or less than $96,000. There's a proportional phase out for AGI between $96,000 and $116,000, and there's a full phase out, which is when there is no deduction if AGI is equal to or greater than $116,000. If one spouse is an active participant and the other is not, there is no phase out. If the couple's AGI is equal to or less than $181,000, and there's a proportional phase out for AGI between $181,000 and $191,000, and a full phase out if AGI is equal to or greater than $191,000. If either spouse is an active participant in an employer's retirement plan, there is no phase out. If the taxpayer's AGI is 0, there's a proportional phase-out for AGI between $0 and $10,000, and a full phase-out if AGI is equal to or greater than $10,000.
For all taxpayers, to the extent the maximum deductible contribution is phased out based on AGI, taxpayers can still make non-deductible contributions to reach the contribution limit. Earned income limitations that apply to deductible contribution limits also apply to non-deductible contribution limits. Earnings on non-deductible contribution limits grow tax-free until the taxpayer receives distributions from the IRA. On distribution, the taxpayer is taxed on the earnings generated by the non-deductible contribution, but not on the actual non-deductible contributions.
There are penalties regarding withdrawals from traditional IRAs. If a taxpayer desires to extract funds from his or her traditional IRA account after he or she reaches the age of 59 and a half, they will encounter no additional fees. If the taxpayer decides to pull before reaching the age of 59 and a half, the taxpayer will undergo a 10% early distribution penalty of the amount of the extraction. Like with anything, there are exceptions to this IRA rule, as some extreme circumstances are up for exemption, which we will talk about in the next slide. These earnings are dispersed as a life annuity with fixed payments every month or year of the taxpayer's life. There are also rules on when the taxpayer must receive their first distribution. This rule being that the taxpayer should obtain their first distribution by April 1st in the year after he or she turns 70 and a half years of age. Traditional IRAs are very similar to 401k plans. Just like 401k plans, traditional IRAs are taxed as ordinary income. Traditional IRAs also have similar distribution rules to 401k plans, so it is in the best interest of the taxpayer to try to avoid the 10% early penalty fee while still attempting to maximize the tax deferral on their traditional IRA accounts.
There are some exceptions to the 10% early withdrawal penalty that allow people to withdraw from their IRAs without paying the fee. These are described under Internal Revenue Code Section 72, subsection T. Some of these exceptions are 1. If the distribution is dated after the taxpayer is 59 and a half years old. 2. If the reason is because the taxpayer is disabled, however, they must pass certain requirements to qualify, which are described under Internal Revenue Code Section 72M7. Third, if the reason for the withdrawal is for qualified medical expenses that exceed 10% of the taxpayer's AGI. Fourth, if the withdrawal was for health insurance premiums to the unemployed taxpayer. 5, if the withdrawal was for qualified higher education expenses. 6, if the reason is for a first-time home purchase, but this is limited to $10,000. And finally, if the owner of the IRA has been called to active duty. There are several more listed under Code Section 72, but these are the main ones used. And now, here is an example that applies what we just went over.
Then earns $100,000 a year as a lawyer. He decides he wants to start saving for retirement. Mike heads over to his local bank and sets up an individual retirement account. Mike decides to deposit $10,000 into his IRA. This money is tax deductible, meaning Mike doesn't have to pay tax on the money until he withdraws it. Mike's tax rate today is 30%, so he saves $3,000 in taxes. Because Mike deposited $10,000, his taxable income this year drops to $90,000. Fast forward 30 years. Mike is now retired and wants to withdraw that $10,000. Since he's retired, his income is now much lower and is therefore taxed at a lower percentage. So, because he is now withdrawing his money at a lower tax rate, Mike only has to pay $2,000 in taxes, as opposed to the $3,000 he would have had to pay had he not opened up his IRA.